Hello everyone, welcome back to the channel. In today's video, we are going to break down one of the most important concepts in CRT, which is how to identify the draw on liquidity. Many traders understand the CRT range, but they struggle with knowing where price is actually targeting after the liquidity is formed. So, understanding the draw on liquidity helps you stop taking random entries and allow you to follow where the market is most likely trying to deliver price. In this video, I will show you how CRT traders analyze liquidity, how they identify the target of price, and how you can use this knowledge to improve your trading setup. So without wasting time, let's get straight into the chart. Today, I'm going to be teaching you guys on draw on liquidity, and this is a simple guideline on how to find or determine a draw on liquidity to frame a particular trade. So in this, I'm going to be showing you guys using a PDF. So how to determine your draw on liquidity. This is a complete guide and also a complete explanation on how to use draw on liquidity. Now, looking at this guide, what is draw on liquidity? Draw on liquidity is a crucial concept in trading. It refers to how the market targets liquidity pool, typically located at highs and low and around key price levels. These are where liquidity are being identified. So when you understand draw on liquidity, it helps traders anticipate price movement and also make informed decision in order not to take the wrong liquidity area and get stuck at the moment or at some point. This is the most important aspect of your analysis, and it should be first prioritized in the trading space. So when you understand that price is targeting a particular direction, you are going to move in form of that direction using candlestick pattern, because we are not SMC traders, rather are we more of CRT traders. We are candle range traders. We identify draw on liquidity, knowing where a candlestick is trying to push and also knowing where retracement is trying to come in the candlestick. So looking at this candle here, you can see that the first candle is a range high and also a range low. So this candle is a range. And remember, I taught you guys on episode 2 that every candle is a range. So if we are going to be bearish, that bearish high is going to be a short-term liquidity. So we have short-term liquidity and also we have long-term liquidity. So if we are bearish, the high of a range or the high of a candle is a short-term liquidity. And why is it a short-term liquidity? It is a short-term liquidity because price is trying to target it to clear liquidity that is resting above before we are going to target our long-term liquidity, which is the draw on liquidity. So here is a short-term draw on liquidity, and it was hit, and the moment price hits this candle, the high of this candle, you can see how price is going to target the long-term draw on liquidity. So in the next diagram, you can see how price targeted the next draw on liquidity resting below this area. So importance of draw on liquidity in this aspect, I'm going to dive into the chart and show you guys some example of how to determine draw on liquidity on the market using CRT concept. Now, understanding draw on liquidity is crucial because it helps traders anticipate market move by identifying key price level where liquidity pools such as the swing high and lows accumulate. This level often act as also the market of price, you get. So these levels are accumulation points where price targets in a particular time, in a particular time, and recognizing them improve trade timing and risk management. When you understand draw on liquidity, it sometime at some point when after mastery, it helps you know where the market is going to. It helps you know how to get into the trade and how to also get out of the trade. This is why draw on liquidity is very, very important. It is very crucial in our trading aspect and in this era when trading in the forex market. Draw on liquidity also reveal where the institutional trader might step in and also allow retail traders to align with smart money. When the draw on liquidity is formed, when a trader anticipates the draw on liquidity, probably the buy side or the sell side liquidity. It helps you know how to apply your risk management in the direction of where price is going to go. Now, draw on liquidity also, allow retail traders. We that are retail traders in the market, we are not the big boys, and that we are not also the bank. It helps us to navigate how to get into the trade, joining the big boys in the forex market, the intrabank system, and know how to join them and also go with their order flow. So this is how draw on liquidity is more important to us. Looking at the diagram, price cleared the high of this liquidity and what targeted the low of this liquidity. So price, there was a transmission of liquidity. And what is liquidity? Liquidity is simply money. So if you don't know what liquidity is, it is actually money. So money was transferred from this high then to this low and was delivered to this low. So this is how to anticipate draw on liquidity. Now there are types of draw on liquidity. We have the short-term draw on liquidity, and also we have the long-term draw on liquidity. Now, short-term draw on liquidity helps us identify where retracement profile or shorter moves can end. It is used to determine where the market is initially drawn to in the immediate price action. So this is the candle here, and when we have a candle, this is a typical range of in a candle. One candle is a range. When you break it down on the lower time frame, you will see price giving us higher highs and higher lows to the upside. And if it's for a bearish candle, you will see price giving us lower low and lower highs. So the high of a candle is a short term draw on liquidity if we are bearish, and the low of the candle is a long term draw on liquidity. So these are the two types of draw on liquidity. And what is long term draw on liquidity from this aspect? Long term draw on liquidity is all about the move that happened when price is trying to expand after it clears the short-term draw on liquidity. That expansion is what we call the long-term draw on liquidity. It helps us to see where price is heading in the bigger picture beyond immediate market reaction. This is used for understanding where price is likely to go as part of a broader narrative, that guides us in the larger move of the higher time frame, like the daily time frame, the weekly time frame, and also the monthly time frame. So for us to understand draw on liquidity, we need to understand order flow. To determine draw on liquidity. Now, what is order flow? Order flow is simply without dilly-dallying. Order flow is simply when price is giving us a bullish structure, telling us the market is in a bullish direction, which means price is giving us higher highs and higher lows. You can see that price is breaking below lows, um, price is rejecting below lows and breaking above highs. This is simply how the order flow is. So we are expecting on an order flow to give us reject below low and break above high if we are bullish. So yeah, and also if we are bearish, we are expecting price to reject above highs and break below lows, giving us like a break of like a break of structure pattern. This is how to determine the bearish order flow. So now, order flow, to determine draw on liquidity first, you all must understand about order flow. Order flow is very important for determining the draw on liquidity. So if you understand order flow correctly, then you can easily determine the draw on liquidity. Now, how to determine it is also by breaking above highs and rejecting below lows. This is equal to bullish order flow. That is to tell us that price is in a bullish direction. And if price is breaking below lows and rejecting above highs, this is to tell us that what? That price is in a bearish order flow. So draw on liquidity, it can be the following different form. Draw on liquidity can also be a form of a candle range high and lows. Draw on liquidity can be in form of CRT highs and lows, and it helps traders anticipate price movement more accurately, enabling them to take advantage of liquidity. So draw on liquidity is simply can be formed when we have three candle CRT, which is called the classic CRT that I taught and also mentioned in our episode 1 and episode 2 series. So it can be formed with three candles CRT, whereby swept liquidity and also targeted the long-term draw on liquidity. So without wasting much of your time, let us dive into the chart and let me give you examples of how to determine draw on liquidity on the higher time frame, then breaking it down to the intermediate time frame to frame, a trade idea. Now, looking on this trade, this is Euro USD on the higher time frame. This is the weekly time frame. Now, what you can see price does, remember I said that whenever price is rejecting, price is rejecting above high, then breaking below lows. We are what? We are anticipating a bearish market. Reject above high, break below low is showing us that price is in a bearish direction. So let me give you an example of for a bearish way to find draw on liquidity for CRT traders. Remember, this is for CRT traders. It is not meant for SMC traders, because we have a particular way we look at the market structure and anticipate price movement. So looking at the weekly time frame, pay close attention to the way I'm going to analyze this candle. Now, looking at this guy, you can see that, for example, we have price created a range here, and the moment price created this range, this second candle, which is the bullish candle, cleared the high of this range. So this is the short term draw on liquidity resting here. So this is a short term draw on liquidity. When price cleared the high of a candle, then targeted the low of the previous candle, it is called short term draw on liquidity. So price cleared the high of this guy. This is when targeting the short term draw on liquidity according to the PDF I shared, and you can see how price targeted the candle range low. And remember, I said that draw on liquidity can also be formed with CRT, which can also be formed like with the classic CRT, and it can also be formed on the two candle CRT. Any types of CRT I've taught to you guys on episode 1 of this mentorship. So price cleared the high of this candle here. The moment price cleared the range, this high, which is also called candle range turtle soup, you can see how price delivered money or liquidity from the candle range low, which is resting below here. So this is our liquidity point. Price cleared the high, then targeted the low. Now what happened? Look carefully. Remember, price can also form draw on liquidity. According to the PDF, you can see that we also have a way to look for draw on liquidity. So when price is breaking above high, rejecting below lows, this is showing us how the directional order flow is being momentarily moving by buyers or either sellers. So remember, number 2 stated that previous day highs and week highs and lows is also a draw on liquidity. Previous days or week highs and lows are draw on liquidity. So close above is equals to higher price. If the daily time frame or the weekly candle closes above the previous candle, your next draw on liquidity will be the previous day or the previous week high. And also for the other example, which is number 2, closed below equals to lower prices. This is simply telling us that if the daily time frame or the weekly candle closes below the previous candle, your next draw on liquidity will be the previous day low or previous day high. Now you can see how price broke below this candle. The moment price break below previous week candle, the next candle open, went inside, and what? Reject below. Now I'm breaking with the body. Price broke the previous week low with the body momentarily. Remember, price didn't reject. Instead, it broke below the previous week candle with the body. This is another way to anticipate draw on liquidity. We anticipate draw on liquidity according to the previous week candle behavior, how they behave, and also we can anticipate draw on liquidity according to how the previous week candle break or closed or reject below or above the candle. You can see that this candle break below previous week candle, and what happened the next week? The next week open, closed inside the range, rejected, then started selling. The same thing is applicable for this candle. You can see how price break below, reject, break above previous week high. After targeting the liquidity, it rejects, then what? Expand again. The next week or the next day open, break, reject, close inside the range, then expand again, targeting the previous day high or low. The same thing happens day and day in and day out in a particular week and also in a particular day. So this is an example of what has been happening on Euro USD using the chart. So when price delivered draw liquidity from the range high, it targeted the range low and closed as a bearish candle for the week. You see, price closed as a bearish candle for this particular week. Now, what happened the next week? The next week, because price broke below the previous liquidity, we are going to be anticipating a new candle to open, trade inside, trade into a key level, then start selling again. The previous week candle tells us what the next week is going to do. That is how to anticipate draw on liquidity for CRT. Previous week tell the story, then the new week complete the story. Now this candle break below. You can see how this week open closed below this candle. You can see how this week opened. Immediately it opened, it closed below the previous week candle, traded inside a key level, then reject, closing below again. So this is also how to anticipate draw on liquidity. And you can see that that candle was a bearish candle for the rest of the month. So what happened the next day? After price closed below this candle, what happened? The next week opened, targeted liquidity. Remember, price moves from liquidity to liquidity, and I said that it can form as CRT. Now what happened the next week? The next week opened, what happened? Targeted liquidity. Range high and range low are resting liquidity. So price targeted the short term draw on liquidity. Then what happened? The next week targeted and closed below the candle range low. So this is the candle range low. Price targeted the candle range high, which is the short term draw on liquidity. Then the other week opened and what? Expanded immediately, targeting the long term draw on liquidity. Then after price targeted the next draw on liquidity, you can see how price closed with the body. Now what happened? The next week open, price took out the range low, took out the range low. What is the range low telling us? When price is rejecting below, then closing above, what are we expecting? We are expecting higher prices in this type of example. Now, what happened this week? This week opened, cleared previous week low, reject inside the range, and what happened? It traded into a key level, which is the previous week lows. So this is a key level price tapped into immediately. So this week was a bullish week and also a bullish expansion into a key level. So if you are trading down into the lower time frame throughout the whole week, you are going to be expecting a bullish setup in the direction of what price is trying to do. Now, what happened the next week? The next week opened, took out the high of the candle, rejecting above the high of the candle, then closing below as a bearish order flow. And this was the high of the week. So throughout the week, we are expecting a bearish candle. And all this price movement is because price is bearish and we have a particular key level here, an old low resting below there. And this is where price is going from the bigger picture and the bigger perspective. Now, after price open, it took out previous week high, traded into this guy, which is standing out as a bearish order block. So moment price tapped into it, rejected inside, making this our two candle CRT that I taught exactly on episode 2 and also episode 1 of my YouTube mentorship EP1 and also the EP2 that I taught earlier. So price cleared liquidity, then what happened immediately? It rejected inside the range and what? Targeted the candle range low. So throughout this week, we were expecting a bearish market on the intermediate or the lower time frame. So our bias throughout the week is going to be from Monday, Tuesday, Wednesday is more of sales. Now, what happened? That week rejected inside the range, then closed below this candle. You can see that the week rejected above, then closed inside, closed below this candle, which is showing us lower prices. Now, for the next week coming, what are we anticipating? We are going to be anticipating lower prices because price is breaking below previous week low or previous day high. So this is how to anticipate This is how to get your draw on liquidity, or rather find draw on liquidity for a particular week using CRT method and also candle range theory. Now, because price broke below, you can see how the next candle opened, and what happened? Price targeted the previous day low. Remember, previous day low and high are resting liquidity. So price closed below, reject inside, then targeted the candle range low. So which means throughout this week we are bearish. From Tuesday to Wednesday we are bearish. So on the intermediate time frame and also the lower time frame, you are going to be anticipating bearish markets throughout the week. So this is how to look and how to determine draw on liquidity from the higher time frame. So the moment price cleared this liquidity, which is the overall draw on liquidity resting below, price cleared the liquidity, that and this was the reason why this journey has been going through, and for the past few months. So price was just moving to the bearish side, rejecting above and closing below because of this candlestick. So um this is how to get our daily bias. Now, what happened here? The moment price the moment price cleared liquidity below this area, the moment price cleared this ultimate liquidity, you can see that the next candle opened, dump into the range, then target the previous day high. This is a resting liquidity above here. Price cleared the ultimate draw on liquidity. Now we are going to be expecting rejection inside the range because the ultimate draw on liquidity has been cleared. No need for price to keep on going down, because price moves from internal range, from external to internal, and also from external range liquidity to internal range liquidity. So price has finally cleared the external range liquidity. Now we are going to focus more on the internal range liquidity. So price traded up, targeted this candle range high, but didn't clear the range. Now, what happened? The next candle opened as a bearish candle, but all these are still under the CRT that I taught about, multiple candle CRT. So looking at this area, this is a multiple candle CRT. I remember I said that CRT can be formed using draw on liquidity can be gotten using CRT. So looking at this is a multiple candle CRT that I also taught on the episode 1 of my mentorship. So price created the range here. What happened? The next week ranged again as a bearish candle. Then what happened on the third week? The third week was the expansion candle. Price took out the high of this candle, traded into a key level, which is this fair value gap. If you look closely, that you will see that we have a fair value gap resting here. The moment price targeted it, it closed inside the range. And when price does something like this, we are going to expect price to target the candle range low. So you can see that price targeted the candle range low. The moment the candle range low was cleared, what happened again? Price went into targeting the internal range liquidity. So this is how to anticipate price expansion. And also, if you see closely, on the next week, the moment price cleared this range low, it targeted the range high because liquidity has already been what? Cleared. No need for price to keep going down searching for liquidity. So the next week opened, then price closed above this candle, telling us that there is higher prices. Then there is more potential for price to go up because of this particular rejection that happened here. So the moment price rejected this low and break above, this is also higher prices. Remember, we said that rejection below closed above, higher prices. So throughout this month, or this can be on a monthly time frame, this can be on a weekly time frame, and it can also be on the daily time frame. And this same pattern can also form on the 4-hour time frame. So price cleared liquidity, close above, higher prices. What are we expecting? The next candle to open, and we are going to go bullish. Now looking at this candle, you can, because previous week candle closed above this candle, the next candle opened, closed inside the range. Then what happened? rejected inside the range, and immediately it rejected inside the range, price what? Targeted the candle range high. So this is how to trade, or how to anticipate draw on liquidity, to frame a particular price movement in a particular week, to know how that particular week is going to trade. Is it going to trade bullish, or is it going to trade bearish? So this is how to frame and get draw on liquidity. So thank you guys for watching up until this time. You are highly welcome to this channel. Please, if you are watching up until this time, kindly subscribe to my YouTube channel, and let us grow together as we build this academy together. Thank you guys for watching, and stay consistently profitable. Thanks, guys.